Hello, everyone. Happy Money Power Day. Glad you're here either joining us on the day of the event or watching this video afterwards. We appreciate you taking time out of your day to participate in this financial fitness fair virtually this year. So real excited that you're here with us for the webinar on the credit checkup. So my name is Sue Rogan. I am the Director of Strategic Partnerships with the Cash Campaign of Maryland. As you may know, CASH stands for Creating Asset Savings and Hope. We are a statewide nonprofit that works to promote the economic advancement for low to moderate income individuals and families in Baltimore and across Maryland. And we do this work by providing different programs and services, working with our partners across the state to coordinate and to provide these programs. So one of our programs is financial coaching and financial planning. People can work one-on-one with a volunteer CFP, certified financial planner, in our planning program, or with a financial coach for a long-term relationship. We also work with lots of organizations across the state to provide advocacy. So really working on passing legislation or educating elected officials on what are the needs of the people that we're working with. So for example, you'll see in this image that we were able to successfully work to close a loophole for payday lending in order to make this more fair for consumers. We also provide free tax preparation for families who earn under $56,000 a year. So please check that out as well. We also have the Cash Academy's website, which you'll see the link here, www.mdcashacademy.org, which is meant to be the one place that you can go to look and find fact-based financial education webinars at the moment, in-person classes at some time, that are really there to help you build your financial skills. So any topic area that you need some information on, we know it's hard to learn about money. It isn't taught consistently and generally speaking throughout all the educational systems. It may be hard to learn about it from friends and families. So we really provide these webinars to help you get information you need on different topics. We have webinars right now that are really focusing on the pandemic and the impact that it's having on our finances. These webinars are also recorded and then put up on the website, such as this one, that you'll be able to access it whenever you want to and it's convenient for you. So please take a look frequently at Cash Academy and see what different courses are there, and feel free to sign up for one. On Cash Academy, you'll also see that we have put together resources specifically relating to COVID-19 and its impact on our finances in these topic areas. So there's housing, food and meals, replacing income. This is being updated constantly. So again, it's meant to be one resource for you to go and find everything in one place that you can find information on different topics that you may need help with. So please feel free to check that out as well. So that's a little bit about Cash Academy and why we're doing this webinar today. We want to jump into, why does it matter about credit? What difference does it make? Well, generally speaking, it's pretty hard to save up enough money to buy a car or even to buy a home. So at some point, we're going to need to borrow money. And depending on what our credit history and credit score has been, the interest rates will vary greatly. You will see an incredibly different amount of money that you will have to pay for that loan when your credit score is higher based on a very positive credit history. In addition, you may have to pay down payments for utilities or different products. Again, that's going to depend on what your credit score is. And nowadays, credit scores are actually used for things that may not have been originally intended for, such as landlords will often check a person's credit score to see if they will allow them to have an apartment. Cell phone companies, different sort of services that we want are now checking our credit scores. So while it isn't something to stress out over, it is something to take seriously and to try and build a healthy credit score as much as possible. We're going to talk about how you're going to do that. So let's talk a little bit about what credit reporting is. So credit reporting came about in the 50s and 60s across the US because we were getting outside of our communities and lenders didn't really know the individuals that they were loaning to. So they really needed some information or some data to be able to decide whether or not to make those loans. So again, in the 50s or 60s, the credit reporting was done sort of locally, but then it really exploded after that. In the 70s, we really had the emergence of the big three credit reporting agencies. You'll see that's Equifax, Experian, and TransUnion. And because of this practice of collecting data on how we use credit. And that being used by lenders to decide whether or not to loan to us, the federal government actually put legislation in place. It's the Fair Credit Reporting Act to protect consumers, to make sure that things were being reported accurately, or that consumers had the option and the legal right to dispute items on the credit report that are not accurate. So they're really trying to put some protections in there to help consumers deal with this data reporting. And so in the 90s, we're going to talk a little bit more about how the credit scores came about, but there was an expansion of the Fair Credit Reporting Act, which resulted in more consumer protections being in place. It's important to note that no one signs up as an individual consumer to allow these credit reporting agencies to collect data on it. And we don't really have the right to say, no, stop collecting this data. They are collecting data from lenders, but as consumers, we do have the rights, and we really need to make sure we are protecting ourselves so that all the information and the data being reported is correct. So the credit reporting bureaus, their job and the mission that they have for their companies is to gather the information and to organize it about how we handle credit. There are a lot of different credit reporting bureaus. It's not just the main three, but those three are primarily the ones that our lenders are accessing the data from. It's also important to note that as a lender, the company can decide whether to report to all three of the credit reporting agencies at one time or just one. There is no legislation that requires them to report, first of all, at all, and second of all, to report to specific credit reporting bureaus. It is up to the lender or the credit company to decide who to report to, which is why there may be differences in the information that's with the different credit reporting agencies, because different lenders are discussing and reporting data to different credit reporting bureaus. So now we've had just a little bit of a history of what credit is and what credit reporting is. I want to talk to you about how we're going to build and to really protect your credit. So Credit Builders Alliance is a national nonprofit organization that really works on building organizations such as the Cash Campaign and others, knowledge and expertise in credit so we can then help individual consumers. So the Credit Builders Alliance mission is to help organizations move people from poverty to prosperity through credit building. And the philosophy is that good credit is an asset. So my colleague and I at Cash Campaign have actually been certified as master trainers with the Credit Builders Alliance to provide this content for you. So let's talk about what's on a credit report. So there are main areas of information that's on the credit report. The first one is personal identifying information. The next is credit history that talks about different accounts that we have opened up, loans that we have taken, public records, and inquiries. We're going to talk about each one of these. And as I go through them, if you do have questions about this, because it's a lot of information, please feel free to put anything into the chat box, because I will be online during this webinar and will be able to answer your questions. So personal identifying information. This is going to be names and different types of your names, whether you have different middle names that you've used or different changes in your name. Those will all appear on the credit report. Your addresses, both past and present addresses, employment information. If you have a spouse or co-applicants, their information will be on there. Your social security number, your date of birth, and your contact information. It is really important when you check your credit report to look at this personal information and not just skip over it and go right to the credit information. Sometimes we've seen on credit reports that people have birthdays that are not theirs, addresses where they've never lived, names they've never used. That could be an indication that identity theft could be happening, and that information needs to be corrected on the credit report. So please be sure to check this when you check your credit report. So in the credit history section, we have accounts that are in good standing, both those that are currently open or those that have been closed. Your open accounts stay on your report indefinitely. It can be on there 20 years. They're open, they're in good standing, it's totally fine. Closed accounts, however, again, that are in good standing, stay on the report for 10 years after the date of closing the account. There's also delinquent accounts, those where we've had negative history. We didn't pay on time, something happened and we had some difficulties with it, along with amount and collections. So negative information stays on the credit report for 7 years from the date of first delinquency. That is a key piece of information to look for, that it is 7 years from the date of first delinquency. That's important to note because if it's on there longer, you'd have the right to actually dispute that and have that negative information removed. So again, on the credit report, we have the open and positive accounts. We also have the delinquent accounts, which is where we haven't paid on time, or amounts that have gone into collections, which means that another company is trying to collect that debt. Public records are also listed on the credit report. However, the good news is, and the helpful information is that of 2018, new federal regulation went into place that bankruptcies are the only public records now to appear on the credit report. Before, there were other things from public records that were appearing that really didn't play into the risk assessment. That is what the credit reporting information is supposed to be. So regulations went into effect to change that. So for bankruptcies, Chapter 13 bankruptcy will stay on the report up to 7 years from the filing date. Chapter 7 will stay up to 10 years. So inquiries. Inquiries are both soft or hard. So a soft inquiry, as you can see, is initiated by you, the consumer, and some maybe businesses for educational and information purposes, but they don't impact our credit score. They will stay on the credit report for 24 months, but soft inquiries are examples of we check our own credit report. A landlord checks the credit report. An employer, although in Maryland, most employers are not allowed to check a person's credit report for his condition of getting the job, but if it's a federal government, you need clearance, or it's in another state and you're listening to this, some employers will check it. Again, that is a soft inquiry and does not impact the credit score. Now, a hard inquiry is about like what it means, what it says. Hard inquiry is, it's when we have applied for credit. We're asking for a loan, we're asking for a credit card. Hard inquiries initiated in the past 12 months do impact our credit score. So you want to be a little bit careful about how many hard inquiries we are initiating in a short period of time. The hard inquiries appear on the reports and business reports, which means that the credit report we get and we pull it is slightly different than when our car lender is going to pull it. It's going to look a little bit differently, but it will appear, the hard inquiries stay on both for 24 months. So what's not on the report? And it's important to note this because if for some reason you see it, you actually need to make sure that that is changed and corrected. So the following information does not appear on the traditional credit report. So your banking information, not that you're getting credit, but you're using a checking or savings account. Your bank information is not going to be on the credit report. It doesn't involve lending. It doesn't have a purpose in being on the report. Any of your beliefs or affiliations, right? Your gender, ethnicity, religion, political affiliation, none of that's on the report. It doesn't relate to how you've handled credit in the past, and it is not on there. Many current accounts. So again, we talked about in the beginning that lenders choose whether or not to report data to the credit reporting agencies, and typical ones that we see not reporting are going to be utilities, landlords, cell phone bills. A lot of those don't report. So how do you go about getting your report? So the Fair Credit Reporting Act, again, we talked about how that was federal regulation that was put in place to protect consumers, actually outlines the specific purpose for which a person or a business can get the credit report. We as consumers have the right to see the information in a credit file, and it's really important that we do so. We have the right to dispute inaccurate information and receive a response within a specific time frame. So what happens when we see something inaccurate on our credit report? We need to file a complaint either using the online tool or sending in a paper letter, whichever one you prefer, but you want to track when that was sent. So you're going to detail in the letter or the online complaint what information is inaccurate. If you have any supporting documentation, such as a receipt where you've paid this particular bill on time, although it's being reported as being late, you send that documentation in with the dispute. The credit reporting agencies get that dispute and have to respond back to you with the results of their investigation within 30 days. So you're going to need to prove when you sent it, so you can say, excuse me, Experian, I sent this in 45 days ago and I haven't heard anything. What's going on? So if you're going to send it by paper mail, do a receipt where you're going to be sure they've signed for it and you can document when they got it. If you're going to do it online, make sure you do a screenshot or get the confirmation email as documentation and proof as to when you filed the complaint. It is critical for us to be checking the credit report every year. We'll talk about how we're going to do that in order to, number one, make sure everything on there is accurate and that identity theft is not happening to us. The credit reporting bureaus are responsible under this federal regulation for accuracy of the data and integrity of their information in their databases. So it is their responsibility, but we as consumers really have to protect our own credit, check it regularly to make sure everything is accurate. So, how are you going to get your credit report? If you haven't done so already, the website that was set up with the credit reporting bureaus and approved by the government is annualcreditreport.com. Under federal regulation, you have the right to have a free report each year from each of the 3 major credit reporting bureaus, Experian, Equifax, TransUnion. So, what's your strategy for pulling these? Well, you can pull them all January 1st. It's a new year. Let's check to see what's going on. Or you can spread them out throughout the year and try to kind of sort of track what's happening to your credit throughout the year. So maybe you do one in January. Maybe you do one in May. Maybe you do another in September. Maybe some people have said on their birthday, they go and check all 3 of them. Whatever your strategy is, just put something in place so that you will know that you are regularly checking the credit report, again, to make sure that everything on there is accurate. You also have a right to a credit report if you've been denied for credit because of what was on that report. You have a right to see the report to find out what was on there. And if you live in Maryland, Maryland law also provides for a free report every single year. So you can get 3 reports under federal law, 3 reports under Maryland law. Technically speaking, you can get 6 credit reports in a year and be checking your credit throughout that time. However, due to the pandemic, due to COVID-19, the credit reporting bureaus are providing free credit reports every single week until April of 2021. So you have lots of different methods and time frames in which to get your credit report, and I urge you to do so as soon as possible. All right, so that's what we're talking about, the credit reports. Again, if you have any questions about that, put them in the chat box. I'm happy to answer your questions as we're going through this webinar. Keep in mind, I'm a slow typer, so I will get to it, but just give me a little bit of patience. So we want to move on now to credit scores. So credit scores were developed because of lenders. Lenders who let the credit reporting bureaus know, I am tired of reading 26 pages of Sue Rogan's credit report in order to make a determination whether or not to loan to her. So it became time consuming for lenders to have their staff reviewing every single person's credit report. So they went to the credit reporting agencies, and keep in mind, the lenders are the primary customer for credit reporting agencies. Lenders report the data in, lenders actually get the data out in order to make a decision to loan. So they are the main customer of a credit reporting agency. So the lenders went to the credit reporting agencies and said, can you make this easier? This is taking too much time. We need to make this a quicker process for our workload. So credit reporting agencies and my FICO, which is another credit reporting compiler of data to come up with our scores, said, yes, but we'll figure something out. So what they've done is created a math formula that takes the pieces of information from our credit report and assigns it a numerical number. And it's really based on the analysis of the information in the report to represent our credit worthiness. How risky are we with credit? How likely are we going to repay the loan that we are taking out? So again, based on the credit report, and it's important to know that because you have to check your report and make sure everything on there is accurate, or it will really affect the credit score. So it's a 3-digit number. It generally ranges from 350 to 850, depending on which model and which math formula is being used. And it again helps lenders efficiently judge our credit worthiness and whether or not they want to loan to us. So generally speaking, this is the way that a credit score is determined. And we're going to go through each of the pieces here that are listed for the FICO score. So the major part, the 35% you see here at the bottom, is our payment history. What that means, pay on time, pay on time, pay on time. We're going to talk about in just a minute what happens if you miss a payment. It is critical to pay on time. So make sure you've set up your systems and your processes. If you pay online, or if you still mail in, or if you still go in to make your payments, however it is you're doing that, you want to make sure you're getting that payment in on time. The next part of the FICO score, or 30%, is the amount owed. What this comes down to is credit utilization. So this looks at how much available credit we have, generally speaking, on revolving credit. So this is primarily credit cards, although home equity line of credits also get included in this. So it's amount of revolving credit that we have, how much are we using? And the general rule of thumb is to not use more than 30% of your available credit. So just to make this easy for math, think about if you have 3 credit cards. Each one of them has a $1,000 credit limit. That's the amount that you have available to you. So you generally don't want to use any more than 1/3 of that. So you do not want to max out one of the cards. It needs to be spread out over the 3 cards. And generally speaking also, the lower the amount that you use and keep on revolving credit is not only better for you as a consumer because you're paying less interest, it's also better for your credit score. So while 30% is the rule of thumb to not go over, the lower the better. Again, both in terms of interest that you pay and for your credit score. So the next piece of the credit score is new credit. New credit means those inquiries. How many loans have we applied for within a certain time period? How many inquiries are out there on us? And I will just give you one example to emphasize this. A couple were looking for a home. They found a home, they applied for the mortgage. While the mortgage was being processed, they went out and got a loan for a truck in order to move into their home. They also went out and got a loan for furniture to put in the house, all of which was in their spending plan, and they could comfortably afford these loans. But because this new credit was being opened up during the mortgage process and looked like new inquiries were coming in, they appeared risky, and the mortgage was actually denied. So number one, when you're ever in the process of getting a mortgage, do not open up any other credit whatsoever until the keys to that house are in your hand and the mortgage has been processed. Other than that, keep inquiries down as much as you can so there are not a lot of hard inquiries appearing in your credit report that factor into your credit score during a short period of time. The next piece we want to talk about is the length of credit history. So how long have we been able to show that we can manage credit effectively? The longer the better. So if you happen to have a credit card that is older and you're wondering whether or not you should close it because you're not using it, just take a look at the length of credit history of your other accounts and see if they will suffice, or you may consider keeping that one open, perhaps not using it or using it occasionally, but thinking about keeping it there so that it speaks to this part of the credit score. If, however, that credit card has high fees associated with it and you have enough other data to show the length of your credit history, then it may be worthwhile closing that account. It's totally individual and up to you. All right, the last piece that we're going to talk about is the credit mix. And what this is getting at is how many different credit products can we show that we manage, again, effectively and by paying on time. So if you have a credit card, if you have a student loan, if you have an installment loan, a mortgage, these different types of credit products, basically the lenders like to see that we are effective at managing different types of credit products. Again, if you don't have one of those, it's only 10% of your score. It may be worth getting into perhaps an installment loan at some point to increase that part of the score. But if you don't need to do it, it may not affect the score that much. All right, so that was a review of the pieces of credit scores. And I know that that's a lot of information. So again, please feel free to put anything in the chat box and I will get to you. So one thing I want to make sure you understand is that there isn't one number that is plastered on your head, and that's your credit score for today and forever. And that is the definition of how you're handling credit. There are a lot of different types of scores. And the reason is, from the lender's perspective, someone who's lending in the car business versus the mortgage business is weighting different pieces of the data in our credit report differently. They like to think that there's different scales and different accessibility of how we're going to manage this credit by the type of industry that is loaning. So different types of businesses, plus they're assessing different types of risk, different pieces of information in our credit report, mean that there are a lot of different credit scores. Each of the 3 credit reporting bureaus have their own proprietary math algorithm that comes up with their score. FICO has at least 10 scores as of now. So please don't feel like there is one specific number. It is going to be different by day, by month, and even by different types of businesses. Another example I'll give you on that is when I bought a used car several years ago. I went into my financial institution in the morning, doing my due diligence to figure out where I could get the best interest rate for this loan, and said, all right, what kind of interest rate can you give me? And by the way, what's my credit score? That evening, I went to the car dealer and asked the same questions. Yes, I got different interest rates and picked the one that was best for me. I also got different credit scores, and they were different by 60 points. So again, they will be different, and there's going to be a variety of those. You're just trying to get it into the most positive range for you to, number one, be able to get the loan and get the better interest rate. So we're going to go a little bit deeper into the scoring factors here and talk about someone in the gray box that has an emergency or they're emerging or they're rebuilding their credit profile. The blue box has someone who has the typical features of a strong credit profile. So under payment history, you're going to see someone that is emerging or is rebuilding, might have delinquencies within the most recent 6 months. They might have a previous serious delinquency that was 90 days late, or they might have numerous late pays, 30 days late or 60 days late, and multiple ones. Those are going to be ones where the credit score is going to suffer a little bit under this piece of the credit scoring factor. Now, someone who has a strong credit profile is going to have all their payments on time, no serious delinquencies, and consistently uses existing credit accounts. So under that outstanding debt or amounts owed factor within the credit score, the person who is working on their credit, either they were just building it or they're rebuilding it, under this particular piece, they may have maxed out multiple revolving credit cards. They're in crisis mode. They're living and getting groceries on the credit card because that's what's happening right now. And that's okay. It's just important to note that at some point, the credit score is going to suffer a little bit from this, and we'll work on getting it to a better place later. They may have very high overall debt levels. They may have actual difficulty paying those debts. And they might have one single account that is completely maxed out. Whereas the person that has the strong credit profile uses less than 10% of revolving credit. Remember we said the rule of thumb was 30%? That's to keep the credit score in a relatively healthy place. And again, if you use less, it will get healthier. So generally speaking, trying to use as little of it as possible or keeping as much debt on a revolving credit as low as possible. They pay off the balance before the statement date or before the data is actually reported to the bureaus, so the balance is paid off. Again, helps us with interest as well. And all of the revolving accounts keep balances very low. Now, under the length of credit history piece, the emerging or the rebuilding profile is going to have very little or very short length of credit history. The strong one, of course, would have a long history on file. They're experienced. All right, for inquiries, the emerging or rebuilding credit profile, they may have had many inquiries throughout the past year. They may be taking on too much debt, and they might be sort of in a desperate need for cash, obviously using credit for it, and they might be in a bit of a crisis mode, and the lenders are thinking that they're unlikely to pay back the amount of debt that they're incurring. The strong credit profile only is applying for credit as they need it, shopping around for the best rates. And this is an important thing to note, is that the inquiries that we talked about that are hard when we're actually asking for credit, there are these two products here that I want to make sure you know, an auto loan and a mortgage. It is important as a consumer to shop around and try to get the best interest rate, right? You want to pay the least amount of money for this loan. So the credit reporting bureaus and the scoring models have recognized this and have indicated that all of the inquiries on that particular credit product, so the auto loan or the mortgage, not both, one or the other, all the inquiries you do within 2 weeks will count as one inquiry, not 4 or 5. So do your due diligence, shop around to get your best interest rate, but do it within a 2-week period. So the credit mix, again, we talked a little bit about this before. The emerging or rebuilding credit profile only has one type of account on record, but the strong credit profile has different types of accounts and can manage payments consistently through different credit products. So I know we're not in person playing this Jeopardy game, but I thought this might be kind of fun to go through these myth or facts information here. So we're going to read the statement and decide whether or not it is a myth or a fact. If you pay all of your monthly bills on time, you will have a high credit score. So that's a myth. And while you might think it's a fact, because we said the biggest component of the credit score factors is paying your bills on time, the other factors also come into play as well. So even though you may pay them all on time, if you are completely maxed out or going above that 30% of your available credit, the credit score may come down. All right, our next one. If you only have collection accounts on your credit report, meaning that you don't have active open credit reports that you're using, you have accounts on there that are in collections and that's all you have on the report, you actually may not have a score. Myth or fact? Think about it. It is a fact. So actually, if you have only collection accounts, it may not be enough data to develop the credit score. You can ruin your credit by applying for a few new lines of credit or making inquiries. All right, myth or fact? It is a myth. So the point is, it's not going to ruin your credit, right? It's going to affect that percentage point of the credit scoring factors. It may not ruin it, it may affect it, but it will not ruin it. All right, it's impossible to go from unscored, which means you have no score at all whatsoever because there's not enough data in the credit report to generate a score. And you can get a prime score, a really healthy score in 6 months if you have one reported loan paid on time each month. That is a fact. And I will share with you that I was coaching a young adult who got one credit card. It was a secured credit card, and within 7 months actually had a credit score of 720. So it actually is possible to go from not having anything on your report to generate a score to a healthy credit score within the 6 months. Here's where we're getting to the missed payment. While we talked about paying on time is so important. A single delinquency, a late payment, can reduce a credit score by as much as 100 points. All right, here we go. That is a fact. It's frustrating, and sometimes life gets busy and we might miss something, but it's important, really important, to try and put up those processes and systems in place to make sure that you're going to make your credit payments on time. All right, so some best practices for a strong credit score. It is really important to keep it active. So sometimes we hear people saying they've gotten a credit card, but they're a little concerned about the temptation and the ease of using it when going out shopping. And it might just be too easy to swipe when we don't have the money to actually pay for that item. And therefore they think about, I'll just leave that credit card home. I won't use it, but I've got it. So it does show up on the credit report, but unfortunately, because it's not being used, nothing is being reported to the credit reporting agency, so that data isn't flowing. So what we really need to do is to establish and maintain a mix of at least 3 active, either installment or revolving credit trade lines, and pay those on time. So keep that in mind. 3 active installment or revolving credit trade lines. Trade lines mean accounts. So credit cards or installment payment, whatever those are, you need 3 of them, you need to use them, and you pay them on time. A key strategy could be is to put 1 tank of gas on a credit card every month, pay it right off. Do 1 grocery shopping trip on the credit card, the next credit card, pay that off. Use little amounts so that you're not going into credit card debt, but you are getting data flowing to the credit reporting agencies. Keep it low. Lower debt balances on revolving lines of credit. So that means credit cards. Try to keep those credit card balances low, primarily also for the interest that you're going to pay on those balances, but to keep the credit score in a healthier place. And keep it up. You want at least 6 months of credit history and activity, again, meaning using the revolving credit or credit cards that you have on your credit report at any one time. All right, so how are you going to get a credit score? So we talked about how credit reports are mandated under federal law to be free. In Maryland, they're also mandated to be free as well. 1 credit report from each of the 3 credit reporting bureaus per year. But credit scores have not been mandated to be free. So you might be able to get it free at some financial institutions, maybe your bank, your credit card company. They offer those to their customers for free because they feel like it's a service their customer wants. There are credit sites, such as Credit Karma is one of them. These sites you really need to consider carefully if you are comfortable putting in your Social Security number and personally identifying information on these sites in order to get your free credit score. Are there other places that you can get your credit score without having to put into another independent site what your personal information is? We're trying to minimize who has access to our personal information, but people choose to use these because they may offer them offers of credit. Be careful when you're on their sites because that is one of the ways that they generate income. And again, if you're comfortable using it, just monitor what the privacy policy is and the terms of use for your personal data. Some nonprofit credit and financial accounting programs also offer a free credit score. So Consumer Financial Protection Bureau actually has a list of who offers free scores. So go and check those out and see if there's one available to you. Some institutions participate in FICO's open access. There's a program that they have, but you always want to make sure you know which score they are accessing. Credit Karma, for instance, accesses to the credit scores information from 2 of the credit reporting agencies, not all 3. So make sure that you're protecting your information while trying to access a free credit score. So for a fee, you can get it from the annualcreditreport.com's website. You can get it from the issuers of credit scores, such as the individual credit bureaus and lenders. If you're going to go for a loan, as I did with the car loan that I was discussing, I asked people, what are my credit scores? Get it from them for free versus having to pay for it. So just some quick summaries on what is happening with the pandemic and credit. So if COVID-19 has impacted your ability to pay bills because of either reduction or an elimination of income, contact your creditors as soon as possible and try to work out any kind of arrangement with them. Get your credit report. Make sure that you know what's on there and that it is accurate. You have the right under federal law to add a consumer statement next to an account. So for example, if you're unable to pay a credit card bill during this time, you have the right to issue a statement saying that I couldn't pay the credit card bill due to my loss of income with this pandemic. So some lenders may take a look at those consumer statements and understand the situation. Make sure that you're thinking about if you have a federal-backed mortgage or a student loan. Both of these were covered under the CARES Act to help consumers get accommodations from the federal-backed mortgages. Your federal student loan actually was paused until December. No action required on your part. That was paused. But we need to note how this is being reported on the credit reports. So these accommodations are being reported. The orange box is going to show you it's current. So if you were current in your federal-backed mortgage or your federal student loan and it went into an accommodation such as payments being paused, then it's being reported as current during this accommodation. However, you'll see in the green box, if you were delinquent going into this, meaning you're already behind on your mortgage payment or your student loan, the delinquencies can't continue to grow during the time period that these federal accommodations are in place. The blue box is showing us that if you were delinquent, but if you catch up during the accommodation, so maybe you missed a mortgage payment, but you caught that back up, the creditors have to report that current as soon as you catch up. So it's important to really keep an eye on your credit report and see how these things are being reported. There was a time period when the student loan payments that were actually being, by the CARES Act, suspended until December, were being reported as missed on some of those student loan consumers. That has since been changed, but it's important to keep an eye on the credit report just to see what is being on there. So during these phases of a pandemic, here are the phases that you are going to work through if you're being impacted through a loss of income and are concerned about your credit. So the first step is we're just trying to survive. We're just trying to get through this crisis, get our groceries, keep our housing, get our medications, take care of our children. If we need to use credit to get through it, that's what we have to do. The next thing you want to think about is trying to protect it from any necessary damage. So are there ways that you can work through with creditors to have them still report you as being current as you're maybe working through a partial payment? The next thing is to think about recovering. So what is credit going to do to help you get through this phase and actually recover and build your credit score back up again? And then the last part is to rebuild. You can easily rebuild through months of regular on-time payments and reducing the amount of debt that is as you've incurred. So just to review, we want to go over these last things and make sure this, if nothing else, is what you take out of this webinar. The best practices are keep it active, right? Establish, maintain that mix of at least 3 active installment or revolving accounts, pay on time. Keep it low as much as you can. Lower debt balances are much healthier for the credit score. And keep it up. Try and get at least 6 months of credit history and activity going. So again, if you have questions, please put them in the chat box. Really hope that you're going to be able to attend other webinars on Money Power Day or access these recordings afterwards. Feel free to go into the exhibitors and talk with them as well. We want to make sure that this event is very helpful to you. We really appreciate your time in participating and look forward to answering any questions that you may have. Please stay safe and take care. Thanks again for coming today.